Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market. And I'm your host, Kevin Horner. I'm joining you from relatively wet Denver, Colorado. We deal with a little bit of rain over the last few days, but nonetheless, happy to be with all of you today. I am pleased today to be joined by my friend, fellow Schwab coach, Barb Armstrong, in the chat. Barb is a fantastic coach. We are so pleased to have her on our team. She will be there managing details for me while I work through the discussion with all of you. She, of course, enjoys hearing from you, as do I. She'll get to comments, questions that I'm unable to get to, but please feel free to post in there for the duration of the show. We go about 45 minutes in total. And your requests, your questions, and comments will surely aid me today, as this is a solo session. So do look forward to hearing from all of you this morning. I see a lot of familiar names there in the chat already. It's great to see all of you. Glad you are here. If you're not already doing so, please follow Barb and me on X. You can find Barb there, Barb Armstrong CS, and I am Kevin Horner CS. Appreciate a follow there. It's a great way to engage with us coaches outside of the classes that we offer for you here throughout the week. You'll certainly find a number of charts from me throughout the week as trying to just give you updates to what we've noted in prior charts and potential for new opportunities always out there in the market. So that's often what you'll find from me in the X posts that I'll make. So with that, everyone, let's go ahead and cover our disclosures and we can get into the conversation. So please remember that our discussion here is exclusively informational and educational. We do not make recommendations. We do not make endorsements for a specific approach to trading the market. We will, of course, cover some technical analysis viewpoints today. As we do that, we'll remind you that technical analysis is just a piece of your decision-making puzzle. We discourage you from making decisions exclusively from technical analysis, and in fact, probably just encourage a more broader view of your decision-making, meaning it's all a very large puzzle, and you want to utilize multiple data points in making those decisions along the way, everyone. So keep that in mind as well. One final note here is, of course, in regard to the use of our paper money platform, which is what we default to utilizing here in Thinkorswim. That is our desktop application of the Thinkorswim platform, that is. Remember that we work in a paper money version of that tool, but some of the details there involving options are not entirely consistent with real world examples. So you do want to be aware that when you're working with options, for example, you'll never have an early assignment with your paper money version, but it is absolutely something that can occur when working in a real world example. And if you've ever got questions about that, I'd always invite you to reach out and have a conversation with one of our representatives, because we are available for you 24/7 every day of the year. Now, I'll remind you of our process here. We start broadly. We work our way down the major indices, starting with the S&P 500, the NASDAQ 100, and the Russell 2000. We'll move into some tertiary groups, some semiconductors probably, sectors on the move, and get a feel for things. And obviously, we heard from NVIDIA overnight, so we're going to look at NVIDIA today, among a few other stocks in the news. So plenty to get to with all of you. Glad you are here, everyone. I think what we're going to start us off with the S&P 500 is the reminder that it's more of the same. Look, we continue to maintain this upward bias. The green on the chart here that we're seeing both today and over the last week is not to be ignored. Of course, we do not like the idea of fighting against the existing trend. Right now, that can be a little bit difficult even for bullish traders, because we've continued to maintain this steep nature. And I can point to a number of developing details beneath the surface, so to speak, that are keeping traders a little bit on their toes. And a couple of those things. First of all, let's talk about the fact that we are making another high today, moving through the high we just created over the last 2 weeks. And yet, we've got this bearish divergence in the RSI. Now, we know that bearish divergences do not necessarily imply reversals, but they can imply pauses to the broader trend. We're just not seeing it here. So we traders, as much as you want to be cautious perhaps about our opportunity to continue to move to the upside. If you're simply trading the trend, you're not provided, at least to this point, a whole lot of reason to start getting defensive in nature. Now, traders who are feeling as though they need to be defensive, that's a different story. You might not have the detail and price action that'll give you the reasoning to do it. But if you're lightening your load, so to speak, you are building cash, reducing position sizes because you're feeling as though you've made enough of a move or you want to protect profits that you're sitting on, that is okay. There is no reason for you to not lean into the comfort scenario, meaning simply always being comfortable with the amount of money you have deployed in your trades to the marketplace. And I say this frequently, but it's a helpful reminder, I think, for all of us as traders, everyone. And that is that if you're feeling uneasy, it's okay to be bearish by simply building cash, which is to say, not taking bearish positions, but rather just simply lightening up your bullish positions. That can be a step towards bearishness as well, and it can aid the trader in maintaining the portfolio that they want. By building cash, you've got opportunity to capitalize on pullbacks that give you comfort to add, but at the same time, it reduces the risk of your overall trade portfolio by simply not having every dollar deployed to a trade 100% of the time. So please, traders, think about that. Be aware of your own comfort as it relates to the percentage of your dollars that are at play at any given moment. So when we're watching the S&P, many traders are going to default to that 20-day moving average because we've been holding it every step, right? We've got this large area of horizontal support below the 50-day that we have to be aware of. But ultimately, traders might lighten up on a close under the 20-day. Traders might lighten up further on a close below the 50-day. Regardless of that RSI down below, everyone, we are still making highs. So let's not overdo the analysis. If you want to be simple, take the simple approach. We're continuing to hold the 20-day. And many traders would continue to stay invested as long as that continues. We'll see if that maintains. Obviously, there were some questions tied to NVIDIA and the ability to maintain the trend here. We're going to see how that looks. In fact, let's see how it looks as it relates to the NASDAQ 100 right now. We're up 30 basis points, 0.3%. And again, a lot of the same levels of consistency here with the NASDAQ 100. So I have these levels drawn in. Many of you are going to point out we broke that downtrend and we've been holding the 20-day now. So let's lift that level from the detail. And I've got a couple of layers of support along the way as well. And these are always helpful, reminding us of the levels to which we can fall. And obviously, we're not looking for a fall right now because we are clearly back up above the 20-day moving average. Some of you would say that we are getting some semblance of confirmation now that we have 1 day, 2 day, today could be considered day 3, or we could say 4 of the last 5 sessions holding the 20-day moving average. That might be enough for some traders. And again, if we're simply relying on the existing trend, whether you validate that from the 20-day moving average in orange or the 50-day moving average in purple, either one could be validating the longer range trend that we've worked with. So let's not overdo it. Let's stay optimistic as best we can. When I say let's, I'm just simply saying if you're a trend trader, everyone, you're not provided reasons to this point to be looking for ditch out points, right? You know, it doesn't mean we shouldn't be thinking about it. You all know that I speak about this frequently, the need to set the levels where we will individually take action, right? Where we will decide that, okay, that is a move that I'm no longer as comfortable as I was previously. Therefore, I must reduce position size, or I must take some stock off the table, put some more cash in the pocket. Again, if we did that on the 20-day moving average breach that we got last week, my hope is that traders got back involved over the last few days here with the movement above the 20-day. But, you know, again, this is all about planning the level that you want to monitor or manage your trades. Not everyone cares about that 20-day moving average. Some of you are going to be a little more intermediate term in length, and you might work with the 50-day. You know what? If we go back to the 50-day, look how long it's been. It's basically April 30th. Where we recaptured the 50-day, and we really haven't had a whole lot of reasons to be exiting based on that, right? We've not even had a 1 day below the 50-day in the NDX. So even taking all that into account, ultimately price action should dictate decision making for the majority of trend traders. And so whether we've got bearish divergences in RSI or any other metric or any other oscillator, the trend still remains to the upside, lower left to upper right, and we continue to see these trend lines maintained. So set those levels for yourselves, everybody. Make sure they're consistent with your time frame, right? So if you're shorter term, maybe the 20-day. You could be even faster, shorter term, maybe the 10-day moving averages, as Boj is mentioning here. Absolutely possible, everyone, that you could work with one of those faster moving averages if you desire. Just remember, a faster moving average means that you're apt to be taken out of that position a little bit more quickly. So keep in mind that. Let's check out our small caps, everyone. Let's see how we're maneuvering here. The small caps, boy, I tell you, we have had some great improvement from the small caps. As you can all see, we have been watching the action here dating back really to this establishment of what many might call that inverted head and shoulders. And when we're looking at here is that right shoulder, because we recaptured the 50-day moving average and started working largely against the 20-day. There were bouts with moves beneath it, but we have continued in the short run to find support along the way, whether it be the 20 or the 50. We did have a bounce back at the beginning of August, consistent with the 50 crossing the 200 to the upside. We, of course, refer to that as the so-called golden cross. And what we got thereafter was not just a move to new highs, but a breakout followed by the bull flag, which then gave us a nice candle to the upside last week. Last Friday's candle, absolutely gorgeous for the bulls. Not just a breakout candle, but one of those 3.5 or 3.75% days where the whole index moved to the upside aggressively. And then we consolidated for 2 days is it. And now you've got another breakout. So we took a bull flag into another bull flag and are breaking that as well. So now in the near term here, traders probably targeting that next ledge of potential resistance there at around 2440 as the possibility. And that's 60 points away. That is a wonderful level to achieve if we can get there. By no means do we have to, but that certainly gives you current traders at least the optimism and the potential to target it. And I'll just take into account the height of the move we've made here. If we just considered, everyone, that maybe this is the next flagpole, we can just measure the height of that pole and take that line and affix it to the level that we are moving from. And you can see if I did that from the top of that flag, it would be right to the 2446. So you could, shorter term traders who are technicians might build that out and say that that's the measured move goal as well. It happens to coincide with those prior highs. So some traders would take that to mean a proper target, but by no means are measured move targets a guarantee to be achieved. But it is nice for the trader who can put some mathematical consistency behind the potential for these moves based on their technical viewpoint. So that's one way that some traders will look at that. Everyone, for the immediate future, obviously, if we can get there, that would be a wonderful development for the small caps. Let's see what's going on with small caps. As we know, are tied directly to interest rates and the expectation of interest rates. So let's look at the 10-year as well while we're here. And we'll notice that the 10-year just continues to kind of languish a little bit. We'll notice that the level that we hold, support here is pretty clear at around 4.2. on this 10-year yield. We've been here a couple of times just in the last 2 months, bounced off of this ledge, bounced off of this ledge, bounced off of this ledge. So 3 different times. So that tells us that at least that 4.2 is well established. The question becomes, how do we manage this after the potential rate cut? I'll remind you, the last time we had a rate cut, we were at a very low level. We were in the 3.8 zone. We got that rate cut last year, and we actually saw the yields climb aggressively thereafter. So don't mistake an actual decisioning from the Fed, if it is to go that way, to get a cut, that we're instantly going to see rates lower. We can't make that mistake, or that assertion at least. So be at least aware of the levels we reside at. Certainly a move under 4.2 would be a bit of a heads up. That would be a significant development, particularly for the interest rate sensitive groups like the small cap stocks, and of course like utilities and real estate, which are also interest rate sensitive. So be aware of that. Now, I saw some questions, and it looks like Barb has been answering along the way, as we expect, because Barb's fantastic, of course. Thank you, Barb. I do want to address those questions, though, as it relates to some of these moving averages. So let's go ahead and look at the semis as our next group, and then I'll just talk about those moving averages briefly for everyone who might be a newer viewer to the show. What we're working with here, everyone, is a 20-day moving average in orange, a 50-day moving average in purple, and a 200-day moving average in blue. Now, the significance of these, well, these are frequently utilized by many technical traders who are monitoring the trend. Shorter term traders will watch that 20-day moving average, which of course is akin to the last 4 weeks of average price. So there's 5 trading days a week. We get 4 a month, 4 weeks a month on average. 20 to 21 trading days in a month is where the 20-day moving average commonly comes from. The 50-day moving average is, of course, akin to a 10-week moving average, and then the 200 right around, 10 months or so. Now, the thought process is really built on defining the trend in the longer haul as being maybe that 200-day moving average. That's a pretty significant trend, and there's some consistency with the 200-day moving average that a lot of traders will work with, meaning if you're trading the trend, for some traders, they just look at it and say, if it's not above its 200-day, then the shorter term moving averages have less impact on that trader. That certainly can be a process where some would just walk away from trade opportunities if the stock is trading below its 200-day, regardless what it's doing against a 20 or 50-day moving average. And again, that's just consistency for some, their process, the way that they like to trade. Now, more intermediate term traders probably following a 50-day, and then the speedier traders, less time, consistent with their holding position, the number of days they look to trade. You could watch a 10-day moving average, and in some cases, even a 5-day moving average. But the point isn't that you should pick one of these moving averages to follow. It's rather understanding the significance of these differing timeframes, and further recognizing really which is the one that is most respected at any given time. We've noted, for example, the semiconductors, when we talk about the respect, well, what I'm talking about is this move here where we recaptured the 50-day back in early May, and have held it since, right? Now, for a while, there was a very significant period where we held the 20-day moving average with no give up. And then finally, we broke down and had to test some support, which happened to be consistent with the 50-day moving average. This is not at all uncommon, everybody. So something to monitor is maybe the usage of a couple of moving averages side by side to aid the trader in deciding when to be fully invested in a position versus partially invested in a position. So think about it like this, everyone. If you're holding your stock in the semiconductors because we captured the 20-day, and you'd say, all right, I'm going to stick with this 20-day moving average until we close below it, and then I'm going to make a decision to maybe take a little bit off. You would have stuck with it maybe all the way until right in this area here, where we had a few days below it. and you could have been forgiven for taking some off there. If you stuck with it and realized we didn't make a new high, but we ran into some resistance, and you wanted to wait to see if we took out the 20-day again, you could have found yourself maybe reducing position size over this about a week, right? About a 4 to 6 day window where we were below the 20-day there. You had plenty of reason to take a little off. But then here, an excellent hammer candle on this oval, everyone, because what do we see? And when we get a hammer after testing a major area of support, we tested the same levels that we'd bounced off before. We have all of those tails telling us that we've had a shift in sentiment on an intraday basis. That's quite notable. And in this instance, this low that came in, that's the lowest low we've seen in the semis in this pullback, right? So ultimately, this would be considered a successful test, whether it be horizontal support here at around 54.50, or if we called it a test of the 50-day moving average. Take your pick. But ultimately, the trend remains the same, and you can see this, the space, the group itself trying to maintain the upper level and push to the upside, which would be significant, everyone, because, of course, the SOX index here, 5,900, basically the highest we've seen that one. If I pull this back into a weekly, you'll see the same thing, though, right? So ultimately, 59 and 59.31, 59.32 are ultimate all-time high in the semiconductor index here, but it continues to be good. I mean, at least from the bullish trend standpoint, we don't want to be rejected at 5,900, but if we're trend trading and just watching the trend, for a lot of you traders out there, that 50-day moving average is going to be the point where maybe things change a little bit. We have not had that close, so for now, a lot of the same, right? Maybe, again, speaking to what we talked about with the S&P 500, if we are feeling uncomfortable as we push into areas of resistance and you want to lighten your position size, that is always okay. If you're looking to wait for a confirmed breakdown or something like that, some semblance of a pullback that would tell you that there might be a deeper pullback in play, it may very well be that first close under the 50-day, which we still haven't really had since all the way back to May. So there's, again, thinking about what is different in the trend means that becomes an action point, right? A spot where the market does something different in the security or the index we're watching. Well, certainly a close under the 50-day would be different because we have not had that yet. So, yeah, Jay, I love that comment. Trade your plan, but be adaptable to when you see things break down. So I have no trouble with that. I'm a big believer, of course, in maintaining a plan and knowing how you want to act when you move through certain levels. For some of you, it's not going to have any bearing on an intraday move. Intraday price action is not going to give you any reason to do anything, and that's perfectly fine. For a lot of traders, that's exactly what they're going to do. They're going to wait for closing valuation here. More than anything else, of course, right? Not allow intraday price action to be dictating decision making, so to speak. The question about simple moving averages versus exponential, I can make that pretty simple for you, no pun intended there. Of course, the simple moving average just takes the pricing, the closing value over whatever window you're defining. So the 20-day simple moving average just takes the last 20 closes, adds them together, divides by 20. It's equally weighted across the board. But when you start exponential moving averages instead, let me show you quickly the difference here. I'll go ahead and apply an exponential moving average. And for our purposes, I'm going to make this, let's open this up. We'll make it stand out a little bit stylistically so it pops off. Okay, so we're going to make this how about a 50-day exponential moving average, just to highlight the difference. So I'm going to maintain the simple 50. I'm going to hide the 200. So we're going to just see the exponential 50 and the simple 50. Okay. Now you can see the exponential 50 is this white dashed line, and the purple is our simple. They are not terribly different, everyone, right? You can see they're close. All right. But in this instance, the simple moving average in purple has been is actually a little bit higher. It is not all that uncommon to see the exponential moving average be a little bit speedier or tighter to the price action. Ultimately, what I think many traders have learned is that there is not a lot of guaranteed reason to be using one versus another. What I often will refer to this as is simply trader's choice, meaning whichever one makes the most sense for the trader is likely the one that the trader wants to work with. If you have more confidence in a standard simple moving average rather than an exponential moving average, well, then by all means, work with the one that makes the most sense to you. I don't think that deciding which moving average, simple versus exponential, is the true key delineating factor to success. I do think, though, your comfort for how you trade is one of those delineating factors for your success. And so having a consistent approach, whether it's EMAs, SMAs, or some traders using SMAs on these longer range charts and EMAs on those shorter distance timeframes, it's really entirely up to each of us as individual traders. So what I encourage you to do is play with these details, apply them to your charts, make alterations, and see what makes sense to you and aid you in your decision making. Sure, it's important to know the differences between them, but it's more important to have signals with which you can work and that give you comfort to make your trades the way you want. I hope that makes sense for all of you out there. As it relates to deciding, 20-day, 50-day, 200-day, all of that is just, for the most part, tied to the consistency of these patterns or of these trend lines. Most technical traders have learned technical analysis incorporating 20-day, 50-day, 200-day moving averages. So there's a lot of consistency there because many traders watch those same moving averages. So yes, in technical analysis, self-fulfillment is part of the game, but that is not necessarily something to be worried about or wary of. I think it's something to embrace. Understanding that self-fulfillment is part of technical analysis can aid us traders in having the confidence to apply the trades that we want to apply. So hopefully that answers some questions. Thank you, Stephanie. I appreciate that. That's ultimately all we're doing here, of course, on Trader Talk, is trying to generate more understanding of these details and of these potential signals and tools that you might incorporate into your trading. Ultimately, it's all of us individually as traders that need to define our own process. So hopefully that is helpful. Okay, so we're seeing a lot of the same things in the SOX, the semiconductors. Obviously, we're going to look at individual stocks in this space from a leadership standpoint. So we're going to move into individual equities today in the news. The last thing I want to point out is I'm just looking around here. We have the VIX falling a little bit, holding on to that level under 15. We want to continue to monitor this. We talked with this with Mike Bruskoff about this on Monday, and the potential, that as we hang out in these lower levels, to be a little bit uncomfortable with the lack of volatility, but reminding us that a VIX at this level is not necessarily a scary viewpoint, but we can be getting some spikes here and there. So we should be aware that we have more maybe potential for spikes in volatility than we do for crashing volatility from here, meaning we're not as likely to see volatility continue to fall in the short run. We are more likely to see volatility rise. But remember, volatility does not mean necessarily negativity. Right. So we'll monitor that and certainly notice there's that clear relationship between the VIX and the S&P 500. So anyone noting that the VIX was off like 5% at the open today and the S&P 500 was bullish to start us off, we were green. We flipped that a little bit. And so we've seen the VIX rising a little bit as the S&P has retreated. Now, from a standpoint of our sector action, technology is pulling back. The biggest percentage at this point, off 0.5%. Tried to see a little continuation of the move through the 20-day. We had 1 day above it with yesterday's close. It's a little precarious at this moment. We do have this bearish divergence playing out again, as we can see there with a lower high here with a lower high. And if this is the highest high in this move, then this would be a lower high as well. So maybe we need to consolidate further, allow the 50-day moving average to get caught up. There's a bit of horizontal support here in the tech space, but ultimately we're not at all surprised by this, I wouldn't think, right? We've seen a little bit of a rotation out of tech over the last few weeks, last 2-3 weeks, a little bit, as we've tried to see some buoy in some of those lagger spaces like Staples, which has managed to maintain but is not at all trending here. As you can see, we have gone sideways further. I'll point this out. Just, my goodness, we don't really have much of an uptrend at the moment. I mean, a long-range uptrend, sure, right? Dating all the way back to, the fall of 23. So we could say that the last 2 years, ultimately uptrend, lower left to upper right. And yet over the last 6 months or so, 5-6 months, we've really gone nowhere in Staples. Now discretionary is remaining green for the day. You've got a little bit of a continuation move there. Boy, that stands out a little as we've got this like a flag and a stiff wind, right? The flags commonly will show a bit of a resistance point, but the discretionary flag continues to rally a little here. This is pretty intriguing for discretionary traders. We are kind of at an area of short-term resistance that bears watching. The other one that we've really monitored of late here has been healthcare, because there's been a bit of a shift in healthcare. Let me lift some of these details. We still have the downtrend in place. We thought we might be getting out of this recent range here with this action, but now we are right back beneath my white line here. We may find that there's an opportunity for a support test at that last tail. So let me just draw that in here on healthcare, because that could end up being a short-term area. Reminder, many of you traders know we talk about gap levels and the importance of gaps, not the importance of the gap itself, but rather how does price action help us out when we get to these gap levels? Well, it can reinforce an area of potential support. And so if a trader were wondering about the opportunity to hold the low here, which was essentially 1574, well, that level becomes very important, because if we slipped through it and we get down to filling the gap area, yeah, you could see a quick 15-point move to the downside. Could be the 50-day moving average, the 20-day moving average, the confluence of both. But ultimately, an improvement in healthcare over certainly over the last 3 weeks here off of that low in early August, right? This move up has been fantastic. But what we're looking for finally will be a break of the downtrend line that's been working here for quite a while in healthcare, and we have just not gotten there yet, right? So we go back to the peak was September of last year, and here we are looking almost a full year of a downtrend. We have really not broken that yet. So ultimately, we want to see that break for healthcare to be feeling a lot more bullish. So near term improvement, longer term, maybe a sit on your hands type move there as it relates to healthcare, but improving space nonetheless. Let's hit up some of those underlying equities we mentioned here off the jump today, everyone. Let's lead with NVIDIA, of course. We'll talk about what we see in the way of price action. So we've struggled, as you can see, everyone. We tried busting through, even today, tried making a new high, couldn't do it. So now we have run to this ledge basically multiple times over the last 4 weeks, have not popped through. That has to stand out. Today we are trading again below the 20-day moving average after having tried to break there. Now we also have the declining RSI. We have to bring this to note, right? And I'll remind us once more. What does the declining RSI tell us? Well, it could just mean a need for a pause in the longer range trend. And look, we've really not gone very far here over the last few weeks. And I think a lot of traders would maybe put another line in this vicinity and define it as kind of like the range. So we'll call it, let's say 168 to 184. How's that sound? Well, let's make it cleaner. 168 to 183, that's a $15 range. So we'll just draw those in. 168. Duplicate that, and we'll call that one 183. Go. So $15 range, if it holds, everyone, terrific. not negative. That's okay. What we don't want to see is the takeout of 168, which would give us a potential for tracking back to about $15 below that, which we would then say, whoops, I didn't want to remove that. Let's duplicate it, which would be about 153. And let's just find 153 on the chart. And it's going to be right around here. So it's always intriguing to the chartist when those levels line up, everyone. What you had here was a bull flag breakout, and basically the low of the flag is 153. So if we're just talking measured moves, that's the kind of thing you might be looking for. And again, we need to remind ourselves measured moves are never guarantees, just approximations. So wanted to make sure we put that on there. Now, let me give you the headlines here. So there's your technical look at NVIDIA on the daily chart, incorporating RSI in a bearish divergence, which we may be in the midst of playing out right now. Goldman Sachs maintains a buy rating, $200 price target in their first take note on NVIDIA after their second quarter results. So notable 200. KeyBank raised the firm's target to 230, up from 215 on NVIDIA, keeping an overweight rating on the shares. JP Morgan raised the target to 215, previously at 170, maintains an overweight rating on their shares. Citigroup raised the firm's target to 210 from 190, maintains a buy rating. Bernstein raised the firm's target to 225, previously at 185, maintains outperform. Bank of America raises to 235 from 220, keeps a buy rating. Oppenheimer finally raises the target to 225, previously had been 200. They maintain an outperform rating. That's a lot of updates to the position, not a lot of upgrades. Tough to upgrade a stock that's been a buy or an overweight rating for a long, long time. But you can see from the price target adjustments, which are never guarantees, whether it's the analyst or measured move, never guaranteed to be achieved, yet you're seeing a lot of improvement from those. If we take a brief pullback to that weekly look of things, everyone, what are we going to say? I mean, an incredible move to the upside over the weekly pattern. Taking out prior resistance was the key. And as you can see, we've not exactly had much of a pause in here outside of the last 2 weeks as we've consolidated since breaking to the upside. And why is that important? Well, how many of you have had trouble buying stocks that are breaking out to new all-time highs? If you're one of those traders, you can certainly raise your hand here. You're not alone. Many traders have this difficulty. I was a trader that had this difficulty historically. It takes time to work through that concern, that struggle with the idea of paying more to buy this stock. But ultimately, when you take the lid off of things like this, take the lid off of a stock where it had been banging its head on resistance, and then that resistance gets cleared, this is a not all that uncommon development thereafter, which is to notice the uptrend consistently thereafter. So pretty nice move there out of NVIDIA following the breakout on the longer term chart. And while it's not having a green day at the moment, we are off about 1.75%. Hopefully have provided some levels that shorter term traders want to keep an eye on in the immediate future, and areas for you maybe to raise some X strategy concepts if that's what you're looking for. Okay, we did have some upgraded stocks in the market today, so I'm going to bring in one of them here. It's Wynn Resorts. Wynn Resorts was upgraded at UBS to buy from neutral. New price target is 147, up from 101. The firm cites the increased Macau estimates and a more bullish view on Wynn's AI Marjan Resort for this upgrade specifically. The market will leave the company's December investor day with similar views, according to the analysts. So basically stating, hey, be on the watch for what comes in their December investor day, and basically saying, hey, this is when you're going to start to hear why we are bullish on the stock. What I find interesting from the technical standpoint, we just got done talking about stocks breaking significant areas of resistance. Look at what's happened here over the last week or so. My goodness, this thing was just in a nice little consolidation, nothing to see here, just kind of banging our head on that 112 level, 113, and then just broke out to the upside with an explosive move, even with a nice little increase to volume of late. So a lot of green on the chart, and some of these big days have been with bigger portions of volume. And a lot of you traders like to make note of average volume. How does that look relative to what we're seeing? Well, I love the idea of incorporating volume average, because what a lot of traders are reminded by looking at average volume is that when you get, whoops, what I want to do is move this up into the volume space. My fault. Here we go. What you get when you apply average volume, everyone, is the reminder that it takes more than a retailer, that is to say you, me, my parents, yours, it takes a lot more than us to drive volume that exceeds a 50-day average of volume. That means that yesterday's volume there, that is not likely you and me piling into this stock. That is much more likely the large institutional investors piling into this position, leading to a breakout like this. So a consolidation that went basically, range to range. Let's just talk about it from here. The low in here was 102, the high 112, we'll call it, for 10 points, gives you a potential target of 122, and it's already been achieved on Wynn Resorts. So can't really argue with a breakout like that. And hopefully a few of you in the trade room here have been participating or might be participating in this one as we speak. Now you have an opportunity to maybe work with, building in your exit strategies, giving consideration to a multitude of thoughts, such as standard stop order, maybe a trailing stop. Maybe some traders would be selling into strength like this to pat themselves on the back and say an excellent trade, mainly because, hey, you've already made the standard measured move in the short run. Maybe this becomes an area to take a little bit off and see if you can maintain the other shares that you stick with for the immediate future. So this is always an interesting one. But I'm going to also point out, by looking at the weekly, when you take a peek at this, having broken this significant downtrend line, maybe that was the most notable detail, everyone, because if I pull that back and add in, boy, look at where that catches. So there's that same downtrend line. Where was it significant? On the breakout right here, this huge candle day back in July. And my goodness, that worked out fairly well, right? Because if you would have taken that break of the downtrend as an initial signal, you could have, even if you bought in, by the way, on the worst day, the worst time of that point, and you held it right now, still be up about 22% on the trade, which would be phenomenal, right? For a very short-term window, we're talking 42 bars. That's pretty quick. That's only 2 months. So excellent development for Wynn. Always like to point these out when we find them in the wild like this, because the patterns, the strategies, the processes that traders incorporate, that's what we talk about here on Trader Talk. And to find these instances, even though we have to go back in time, they can be very, very helpful for the trader who then says, all right, I've seen this play out before. Now I can be a little more confident. We've had this maneuver. We broke short-term resistance and the stock started trending from there. I've seen it play out. Many times, we traders need to have that existing experience, that experience from the actual market that'll dictate our opportunities for us. It's very difficult if you've not had that experience. So hopefully that's what we're taking away from some of these conversations today. Everyone, we're going to go ahead and wrap it there, but I want to remind you there's much more to come from us here on the channel today. I will be back a little later at market close at 4 p.m. Eastern. We're doing, of course, the after the close segment I'm back for. So that's great. Hopefully I'll see some of you there, where we'll set the table, so to speak, for tomorrow morning, Friday morning. Later today, though, we've got more, of course. So you've got, you're going to be hearing next long verticals and diagonals. That's with our friend Cameron May. And then we've got Trading the Trend a little later. Barb will be on for that. So plenty to come from us. We hope you all stick around and make note of what's on the channel for you later today. And hopefully I will see you all again. But big thanks to Barb today for managing the chat. I know we got to a few of those questions here on the fly, which I love doing with all of you. Take a minute and follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. And if I did all right for you today, I always love hearing from you, but that thumbs up down below really helps out. in getting us out there in the YouTube algorithm. So after a review, this will be out in the archive for all of you as well. Doesn't look like we got a survey opportunity today, but that's okay. They come through when they do. Again, if you'd like to convene with me outside of the class, the best place to do that is on X. So with that, thanks for being here, everyone. Thank again to Barb Armstrong there in the chat. I look forward to seeing y'all again real soon.